A warehouse does not become worth $1 million more because someone paints the walls. It happens when the income changes. That is the part most people miss about commercial real estate. Most people look at a warehouse and see a building. An experienced investor looks at three things: the land, the usability, and the income. This property was purchased for $1.25 million. At that price, it was not a trophy asset. It was a functional industrial property with room for improvement, better tenant structure, and stronger income. The opportunity was not just in what the property was, the opportunity was in what the property could become. The first step was stabilizing the asset. That means improving the parts of the property that matter to tenants: access, yard space, security, power, usable shop space, parking, and basic operational layout. Industrial tenants do not usually care about granite countertops or fancy finishes. They care about whether trucks can get in and out. They care about whether their equipment is secure. They care about whether the site works for their business. Once the property becomes more useful, the lease income can increase. And in commercial real estate, value is heavily tied to income. Here's the simple math. If a property produces higher monthly rent, the net operating income goes up. When the NOI goes up, the property value goes up. That is why a warehouse bought for $1.25 million can realistically become worth $2.25 million. Not because of hype, not because of speculation, because the income supports the value. For example, if a property generates around $135,000 in annual NOI and the market values similar industrial assets at a 6% cap rate, the property value is about $2.25 million. That is the commercial real estate formula most beginners need to understand. Value equals income divided by cap rate. So the investor's job is not just to buy cheap. The job is to buy something underperforming, improve it, stabilize it, and increase the income. That is how forced appreciation works. Residential real estate often depends heavily on comparable sales, while commercial real estate depends much more on the income stream. If you can increase the reliable income, you can increase the value. That is why industrial redevelopment can be powerful. You are not just betting on the market to go up. You are creating value through better use. A $1.25 million warehouse does not become worth $2.25 million by accident. It happens through better leasing, better site function, better tenant fit, and stronger income. That is the difference between buying real estate and building value. In commercial real estate, the building matters, but the income is what creates the value. This is Built and Bought, where we study business, real estate, and the lessons that create long-term wealth.